Good morning, and thanks everyone for being with us today. I'm Adam Newman. I'm a partner and senior wealth advisor with the firm, and I'm going to be handling today's presentation titled The Hidden Risk of Your Portfolio. I'm excited because without a doubt, the information we're going to cover today is both relevant and timely. As investors, a really big part of our job is always asking questions. We want to question our process, the way we think, and honestly be able to assess how we've handled really tough market environments. So the presentation is going to be organized in a way to help us all ask questions together and determine at the end where there might be gaps in the way we approach the markets and build portfolios. Although we're only halfway through the year, what's happened so far in the events of 2020 have without a doubt, they've presented unique challenges to investors of all experience and skill levels. So I hope regardless of your background, you're able to walk away feeling like you've learned a thing or two. Our primary goal is going to be able to give you some actionable steps to consider as we look ahead to an uncertain environment. Before we get started, I just want to couple a couple of quick housekeeping items. First, I'm going to do my best to keep things under 45 minutes, but please know if you've got to hop off at any time, we're going to be recording this, and that'll be made available, and we'll actually be sending that out to everyone in the next week or so. And then secondly, to save time and to be efficient, we're going to hold off on taking questions live. But I've got an email address down here below on the left, seminar@berniewealth.com. You can submit any questions you come up with along the way to this email address. And I promise you, we're going to get back to everyone shortly. So the presentation, it's evolved over time, but I think it accurately reflects the kinds of conversations that we are always having with our clients and prospective clients about building portfolios and helping people identify risk and opportunities. So we always need to remember we're investing for specific goals and there's a purpose behind our money. So our portfolios and our behavior need to be directly aligned with that and not compete against it. We're going to break down our discussion into 4 parts. Part 1, we're going to do a reflection on what's happened so far this year. What exactly happened and how does that compare to other more recent bear markets? Part 2, I'm going to focus on investor behavior during the most recent sell-off as well as past sell-offs, and we're going to use that to provide some tips so we can safeguard ourselves against potential bad behavior in the future. Number 3, we're going to really hone in on what we think are the key drivers of your portfolio return, and doing that by answering the question, what really matters when we're choosing investments. And to do this, we're going to use a case study, and we're going to look under the hood of a stock and bond allocation of a prospective client, and we're going to identify risk and opportunities together. And then finally, I'm going to wrap up by providing some insight into how we've managed through what's happened so far this year, both the sell-off and the recovery, and most importantly, how we've been communicating with clients during this period. And so I'm going to use some examples and some context to also help you ask questions as we look ahead. So this is not only going to be backward looking, but we also need to be, forward looking as investors. But taking a look at what's happened so far, and really the market behavior in the heart of the COVID-19 sell-off beginning back, it began around mid-February and continued through towards the end of March, around March 23rd, that would be the day that we would say the markets identified and formalized the bottom and began to turn higher. And a majority of the focus in the financial media and the headlines always tends to be on the S&P 500 and the Dow, both which really only represent U.S. large cap companies. But we're going to be a little bit better than that, and we're going to look at a larger set of opportunities, most importantly and specifically the 4 broad stock asset categories and the 3 main bond asset classes, which I would say make up most of the potential building blocks for an investor's portfolio. And our first lesson and main takeaway as we evaluate this information is that not all stock categories are the same, and certainly not all bond categories are the same. We're going to build on this concept as we move forward, but just notice the difference in returns and the variation between the classes. And now that we've looked at the ugly part of the year, let's see what happened really from that bottom of March 23rd and through the most recent month end of May. You'll notice the categories that initially sold off the most also experienced the strongest recoveries. some of these categories, especially like U.S. government bonds, they've hardly moved this year, and they've actually been pretty boring from a volatility perspective, while other categories, such as small cap stocks, they've had significant up and down swings. So to learn from our experiences in the markets, we need to understand how these different categories behave, and ultimately the important question, which is what should and should not be included in my portfolio. They call this the asset allocation decision. So although each market sell-off feels new, and we've all said the phrase, especially this year, well, this time is different, the behavior of these broad categories actually is strikingly similar each time. So because of this, coming up with an asset allocation plan and focusing a lot of our attention there allows us to add a level of predictability and, most importantly, set some guardrails for our expectations and our upside and downside potential with our investments. So if we map this out, the events of this year in a more of a 40,000-foot view, we get a good visual representation of the coronavirus sell-off and the recovery in stocks. And what we're soon going to notice is these sell-offs oftentimes, and many times, they look exactly the same. So we've gone from the COVID sell-off now to the previous 20% decline in stocks that happened in Q4 of 2018, both very quick sell-off and relatively quick recovery. So these similarities and these patterns might make us think it's easy to act on these movements from a timing in and out of the market standpoint, but what you're going to see is reality and our behavior really tell us otherwise. Most investors are notoriously terrible market timers. So this chart, which again looks just like the previous two, is going to represent stock performance during the great financial crisis of 2008, and it's comparing the return of the S&P 500 to movements in investor cash allocations as everything was playing itself out. So you'll see the blue mountain chart at the bottom being investor allocations in cash, showing significant increases in cash positions literally right at the bottom of the market. And even more worrisome than that is that you'll notice these cash allocations, they stayed relatively elevated during most of the recovery. So investors sold at the worst possible time, and they took way too long to fully recommit themselves. And this is how you miss out on significant investment opportunities and recovery opportunities. It's a little early and the data is still coming in, but Fidelity released a study just about a week ago confirming, again, what we would expect, that a significant percentage of investors also went to cash during the COVID sell-off as well this spring. Even worse is they broke this out by age, and what you'll notice is that most of these investors, and the highest concentration of investors that went to cash, were in and around retirement age. So failing on the markets and missing out on what are often quick and surprising recoveries can really damage financial plans and create unrecoverable damage to a long-term investor's return. These recoveries typically happen well before things feel safe again, as we saw recently. I can't tell you how many investors and clients were saying, you know, I'm going to go to cash and I'm going to wait until the economy starts to reopen. I'm going to wait for a vaccine. A very key theme of investing is that the markets and the economy in the short term do not always agree with one another, and they don't need to act and behave the same way on the same information. So many of the investors that failed, they were either taking too much risk to begin with, or they really didn't have confidence in their plan and their future. And this is exactly the role that your advisor should be playing. So why do we keep doing this and making these decisions? I'm going to try to explain it in two ways, our brains and our process. And there's been some major studies released on how investors significantly underperform the market. And many of you might have seen these, making the headlines. Some of the more prominent studies, like the ones conducted by Dalbar Institute and Vanguard, they show and they quantify this as several percentage points of investor underperformance per year. And this is not necessarily because people are really bad stock pickers or bad at selecting mutual funds. It's all about behavior. Collectively, we sell low and we buy high. We can talk for hours probably about why this is the case, but it boils down to a basket of biases that we have and perceptions we have about our abilities to make winning portfolio decisions. We're generally way overconfident. We place a lot of emphasis on recent market performances, too much emphasis on recent market performance. We only like to look at information that confirms what we think is true, and we do whatever we can to avoid short-term losses, even if it's at the expense of longer-term gains. And we do all this even when we know, especially as it relates to the stock market, that bear markets are very common, they happen, and there's always a robust recovery that follows. It's all part of the investor experience. So that's the mental part of the battle. And then we have our process to worry about. And what we've always found is that having a clear process for managing market volatility is going to help us avoid these common mental mistakes that we're often prone to. We've developed a little bit of a recommended playbook for handling these bear markets, and it's going to include four main things. The first is setting clear expectations and understanding that volatility is going to come with being a stock investor or taking an aggressive approach with your portfolio. So educating our clients on what's already happened and looking to the past and learning from that, using that data to provide reassurance and connect what's happening today with what previously happened can go a really long way in calming and educating clients. Number two, encouraging people to stop obsessively and frequently checking their account balances each day or even several times a day. We're all about information and educating ourselves and being informed, but in this particular case, it can be harmful. You know, today we've got our phones, we've got very quick and easy access to finding out what's happening, and we can monitor and react to that at any time. We can trade from our phones. Again, there's pros and cons with that, but it can be disruptive in a bad market. Number three, staying clear from those all-in or all-out decisions, which we're going to talk about when we go through the asset allocation review. This really means don't think of investing as being either 100% in stock or 100% in cash. There's plenty of things in between. And finally, having a proactive and frequent conversations with your advisor to stay on track. As I tell people all the time, CNBC does not know about you, your goals, or what should be relevant to you, but your advisor does. With the behavioral and the market history behind us, I want to now jump into some actionable ideas, starting with the correct order that we prefer to review and evaluate portfolios. So again, we want to have a process for everything. We want to follow a methodology and take a series of steps that lead us to a conclusion. And we found that this is the best way to tackle the analysis of a portfolio. But I just want to put a disclaimer out there that what we're looking at now, it doesn't represent a recommended portfolio. This is an example of a portfolio someone brought to us and asked, can you analyze this and make some observations? And as you've probably seen in the email that was sent out, this is something that on a complimentary basis we're offering as an analysis to everyone on this call. We always start at the top with asset allocation. So the first step is what I think is probably the most important decision that you're going to make for your portfolio. Asset allocation at the highest level is the percentage that we choose to allocate our portfolio across different investment categories. So this is what percentage do we want to have in equities, bonds, cash, or alternatives? And we'll elaborate on that in a second. Studies by a lot of prominent academic researchers found that asset allocation decision is going to explain about 90% of the variability of an investor's return over time. So while most, again, the media is going to obsess over individual stock selection and sector selection, the reality is that those things end up having very little to do with your experience as an investor. So as we see with this investor, they had just under 70% of their portfolio in equities and a majority of the remaining 30% in bonds and cash. And given the high allocation to stocks, I would probably consider this a moderately aggressive allocation. If we're ranking this on a scale, 1 being most conservative, 10 being most aggressive, let's say this is a 7 out of 10. So that's the first observation we'll make. And then second is, and another piece of understanding the asset allocation is the overall concentration of the holdings in your portfolio. So what we did here is we specifically broke down exposure within the top 10 holdings to identify, are there any positions that are making up way too much of the mix? And that top 10 concentration can mean a number of different things, but it's a great way to identify quick red flags. You know, does someone have 20 or 30% of their portfolio in one stock or one sector or one fund? You know, those are things we want to identify and immediately have that sell versus hold decision as part of the asset allocation discussion. So if we talk about these buckets and these options we have for determining, what our asset mix should be, I want to just very quickly refresh what each of these categories are. So we all know and hear about stocks. Their primary purpose, let's say, is to build long-term wealth with a really big emphasis on long-term. They're going to provide us with our highest return potential over time at the price of some potentially very wide short-term volatility swings. Bonds are going to be there for stability and income. They're going to behave differently from stocks, especially in really bad markets. So this is a balancing effect that's going to take place when you hold the right kinds of bonds in a portfolio. Emphasis on the right kinds of bonds. We're going to quantify that and talk about that more. Third would be alternatives, which are defined as anything that's just not a traditional stock or bond investment. These are really for diversification and potentially return enhancement, and they're going to be reserved for higher net worth investors. There are certain qualifications and metrics you have to meet to get into a lot of these alternative vehicles. So given that and the wide range of variety, I'm going to steer clear of getting too deep in the weeds on alternatives for purposes of today's discussion. And lastly, cash, which is going to be there for short-term liquidity needs. A couple of things to highlight regarding asset allocation before we move on to the stock piece of the puzzle. Number one, your asset allocation needs to be clearly defined and monitored. The last thing you want as an investor is a random basket of holdings with no identifiable asset allocation target. If we know what explains most of our return experience, we need to spend some meaningful time determining, quantifying it and monitoring it. Second, we're going to recommend your asset allocation should be a function of two things. Number one, what's your appetite for swings in the stock market? If you are uncomfortable with stock volatility and you find yourself selling stocks during bad markets and have you should probably have a lower allocation to stocks and a higher allocation to bonds and alternatives. That's going to help keep you invested, mostly because you're more comfortable and you're going to be less prone to selling at the wrong time. You won't be like those best investors in 2008 that went to cash at the wrong time and took too long to get back in. The compounding effect of that can be detrimental to your plan long term. Number two, your asset allocation should be tied to the return that you need to generate to meet your goals. They call this the required returns. This is the number that's going to be different for everyone, and it's an output of your financial plan. A good plan is going to tell you what percentage do I need to earn on my portfolio in the context of my assets, my liabilities, what I'm spending, my health situation, and my tax situation. Investing without a plan is always a bad idea. It's going to provide some level of certainty, and it's also going to give you peace of mind when things get out of hand. And investors that typically bail on the market and make these kinds of knee-jerk decisions that we quantified a while back, they usually don't have any of these items covered, which becomes a big reason why their behavior gets in their way. I wanted to give you some examples of what an asset allocation might look like at different potential risk levels. So here you can see target percentage for each of these several categories ranked by level of risk and just some notable characteristics based on historical behavior. So these are examples. They don't represent actual portfolios. They don't represent a recommendation. These are really meant to just guide our conversation and give us context in some of the options we might have when we're making this asset allocation decision, and then what might the output of that being. For example, going back to the two inputs that we think are most beneficial for determining our asset allocation, if we know we've got a fairly moderate risk tolerance, let's say we've determined, my break point for my portfolio is 20%. I don't ever want to see myself losing more than 20%. That's when I feel sick to my stomach, I lose sleep, I'm stressed out. The 20% is our break point, and we know that based on our financial plan, we need to earn 6% a year. That might lead us to a number of different potential options, but using the eyeball test, you could say, okay, as a moderate investor right there in the center, I can likely on a forward-looking basis achieve something close to 6%. And I know with some reasonable level of certainty that my 20% downside limit or threshold could be avoided. So once we have a clear understanding of what the asset allocation should be, we have to keep going. We can't stop there. And a common mistake a lot of investors make, and I see them make all the time, is they set this asset allocation policy and they'll just go ahead and they'll fill each bucket with an index or a random pool of supposed top performing investments. For example, we might say we have a 70% stock allocation and we're going to achieve that target with an S&P 500 index fund or a handful of blue chip companies, and we're going to move on and we're going to call it a day. What we know, just like the research step back asset allocation, history and academics is going to tell us with the stock side of things, we should do otherwise. And just like we said, asset allocation explains 90% or so of your expected return on volatility. A very similar concept is going to apply within your target stock allocation. Research shows that almost 90% of the ups and downs of your stock mix can be explained by your decisions around size and style. And I'll define this. So size is your allocation between large versus small cap companies. Style is your allocation decision between value versus growth companies. And what this means is that if we've got our 70% stock mix we're targeting, instead of spending all of our time determining should I buy Amazon or Google or Pepsi or Coca-Cola, most of the performance within that 70% stock mix is, and the ups and downs is going to be driven by how much do we allocate to large versus small and value versus growth. And this is something a lot of investors don't pay attention to, and these size and style decisions are cyclical. And I'm going to quantify this and define this in just a second. So let's go back to our case study and start to determine how this management of a stock portfolio would work in practice. This client, as we remember, had just under 70% of their portfolio in stock, and now we're taking the microscope to their stock allocation. And what we'll notice here, and we break this out a couple of different ways, is they've got just over 90% of their stock mix in the large cap companies. And you'll also notice that a majority of their stock exposure is in growth companies versus value. You'll notice the term blend here in the center. That's defined as companies that have characteristics of both growth and value. Internally, we clearly define this a little more closely. So for purposes of today's discussion, we'll ignore that. We're going to focus on growth versus value. So is this investor's decision to have a very heavy allocation towards large cap and growth companies a good one? That's the first question we need to ask ourselves. And the answer is, it depends. But for now, just know that the size and style cycle exists, and it's something we should place a very big emphasis on, and that there's opportunities in how we make decisions around large and small and value versus growth. And I'm going to quantify this a little further here. So we've got this chart on the right, which is going to show us year-by-year return differentials in the first column, large cap versus small cap returns, and then in the right column, value versus growth returns. So if you pick any calendar year, if in the small versus large column, if that number is negative, it means that large cap companies outperform small caps by that percentage. And if it's positive, it means smalls outperform large. And on the right, if it's negative, it means growth outperformed value. If it's positive, that's a year in which value outperformed growth. And you just need to focus on the cyclicality of it. It's not an identifiable pattern just by looking at the numbers. You just notice that there's big differences from a year-to-year basis. And if we average all this out, this is from 1994 to 2020, the average annual difference on the size side is just almost 8%. And the average annual difference in style returns is almost 10%. So there's a huge opportunity if you can somehow position yourself within these cycles in the right spot. There is an excess return potential that exists in making these decisions and allocating your portfolio accordingly. So going back to our question, is this investor who had a very heavy allocation towards large and growth companies, are they making a good decision? It really is going to depend. And you'll see why I said that, because if this is a year like 2020, you'll notice that large and growth significantly outperformed value. That would have been a good thing. And if it's a series of years such as 99 through 2005, those are years where small and value significantly outperformed large and growth. So it would have been a really bad thing in that time period. But, when we ask people this question and we're reviewing their portfolios, I'll say, how do you feel about your large growth tilt? They'll either say one or two things. They'll look at me like I have 5 heads, and they'll have no idea that large growth tilt's even there because they randomly picked a basket of investments. Or number two, they'll have some reasoning behind it. They'll say, large and growth is what's been doing really well recently, or large and growth is where the tech companies are, and that's where I want to be positioned. But again, going back to the science of this, we want to be a little more specific and quantified. So these cycles, these size and style cycles, it's something our analytical team is going to monitor closely on a monthly basis. And this is a great visual example that's going to help us show and understand the return differentials between large and small cap companies over rolling 3-year periods. So we're going to focus on the size aspect of it. And simply put, if we're moving up the mountain, the environment is very favorable for small caps, and we start to move into a small cap phase. And if we're moving down the mountain, it's going to begin to represent an opportunity for a large company stock. So just visualize the cycle. It helps us see the up and down swings and the cyclicality of this. The same applies in value versus growth. Same concept, rolling 3-year periods. If we move up the mountain, we're starting to hit a pro-value phase. And as we move down the mountain, we're hitting a pro-growth market. And this helps us simplify the actual math behind it, but I think it's a great visual to get the point across around the cyclicality of things. All of this is a long way of saying that managing your stock allocation is going to require a proactive and a dynamic approach. The size and style opportunity is one way that I think is there for the taking in terms of enhancing return potential. So while a lot of investors don't pay attention to this, they end up getting swayed and they get moved in their portfolios by these cycles. The cycles move them. I can be the best large cap growth fund manager in the world or the best small cap value manager in the world, but if the cycle that we're in isn't conducive to that type of investing, I could still hit significant return and performance headwinds. So once we have our target asset allocation and we now know how we'd like to initially position across size and style within the stock piece of things, we're going to have to move that microscope over to our bond portfolio. And I think that this is where a lot of investors get tripped up and end up making mistakes that are going to lead to surprising risk levels. Going back, we're going to use the same sample client we've been working off of, and we're going to break down the bond portfolio into a couple of different parts. Part one, we're going to focus on something called duration, which is how long on average until the bonds that they're holding are expected to mature. This is going to include any of the bonds held in the mutual funds or ETFs, which often aren't as transparent, but they're there and you have exposure to them. And you'll notice this client, I would say, probably it's a shorter term bond portfolio. The maturity date in the 5, 6-year range. And this is the first eyeball test we can take with the bond side of things. So if someone has an average duration of 10 plus years, we would say your interest rate risk exposure is very high, meaning as rates go up, the price of your bonds go down. The further out your bonds that you're invested in terms of maturity, the more volatile you're gonna be. But this particular client's right in the mid-level range of the duration spectrum. Next thing we'll look at is yield. So what's the average coupon or interest payment that this bond portfolio is kicking off to the client? So you see you're just under 2% being the average yield. Sometimes this number is a lot higher and a lot lower, but looking at that yield number helps us immediately determine if we need to draw a red flag and look towards the bottom of the spectrum, which is credit quality, which I think is the most important piece of the risk end of the equation. Simply put, credit quality is going to be an indicator of risk. And the main and most damaging risk of any bond investment is going to be default, meaning whoever you loan the money to, they can't make the promised interest payments anymore, or even worse, they're not able to repay the principal at the end of the term. Bonds that are rated BBB, you notice on the left, the credit quality spectrum, bonds that are rated BBB or higher, they're considered higher quality, meaning lower risk of default, and bonds rated below BBB, they're considered high yield or junk bonds, meaning they have high yields, so the average yield would be higher, but the risk is a lot higher because their ability to pay and their potential of default is magnified. So unfortunately, and I see this all the time, a misinformed investor, they're only going to look at yield, and they end up with a portfolio of really high risk junk bonds. And these junk bonds, they need to pay higher rates to attract investors. They catch us and they catch our eye with the yield end of things. But then when the market sells off and people see their junk bonds went down as much as stocks, they end up acting surprised. They didn't see that coming. They weren't prepared for it. And again, tying this back into our behavioral problems, that might make us prone to sell at the wrong time. And I'm going to emphasize this a little more by using an earlier slide as an example, going back to what happened this spring. You're going to notice, now focusing on the bond piece of this, the significant return differences between the high yield bonds, government, and corporate bonds. And just like it's really important to focus on this within the stock mix, the same thing applies within the bond end of the portfolio. We need to make important decisions on how do we want to allocate across these types of bonds to match our risk level, to match our return target, and to keep us on track for our plan. So that's going to be a huge part of our experience as an investor. Our preferred approach is we want to stick with the higher quality bonds, BBB and better, for balance. Going back to what's the purpose of each asset class, bonds are there for balance and secondary for income. So higher quality bonds will be less volatile, they'll provide balance, and that allows us to then take our risk on the stocks end of the equation, where we're more likely to get paid over time. This is something known as risk budgeting. Where am I going to take my risk? The answer is you want to take it where you'll get paid for it. We don't need to focus on bonds that are going to be swinging 20, 25%. I'm going to wrap up on our portfolio analysis findings until we look ahead to the future. Number one, we need to get that asset allocation decision right. The questions we want to ask are, what kind of risk should we be taking and why? We want to revisit this decision annually and whenever life changes. So whenever we're going through a transition, whether it's retirement, whether we need to start making more withdrawals from the portfolio, or even when we're starting to save more, we should be adjusting our allocation decision alongside of it. Number two, how are you positioned across size and style? Remember that asset allocation and the size and style decisions, those factors are going to make up an overwhelming majority of the risk and return profile of your portfolio. So don't get caught up paying attention to the little things like picking stock A versus stock B that might not matter as much. And lastly, what's going on in your bond mix? Again, this is something that's neglected, I think, by a ton of investors, and there's a lot of embedded risk we might not be aware of. Are we stretching for yield? Are the bonds providing stability, or are they contributing to our downward volatility? Good questions we need to ask ourselves. And a lot of what we discussed, I know it's timeless, but I want to take a moment to emphasize and use some of that information to talk about what, in practice, we shouldn't be doing in bad markets. And given what's happened this year, I thought it'd be great to use an example and just map out for everyone what's the communication we've been having with our clients this year, what actions have we taken, bringing all of this into practical terms. And one of the common questions we received during the sell-off in February and March was, what should we be doing right now? When we're seeing large losses in our portfolio, it makes us want to take control. It makes us want to stop the bleeding. Sometimes it makes us want to sell and react and move to the sidelines. But emotions are running high in periods like that, so we need to get in front of it. And the first thing we did, and what we've communicated to clients and have found in decades of experience, is we want to let the bear market materialize, let it play out. We don't want to make hasty emotional decisions in the moment. And once the dust settled, we're then able to identify opportunities in some of the oversold or attractively valued pockets of the market, or areas of the market that we think are going to recover the strongest when things do in fact turn around. And this translated into us taking action with regards to size and style. So right around the end of March, we made a pretty sizable shift in our small cap stock allocation, increasing that from right around 75% right around from 25%, increasing that to 30% of the portfolio. So a pretty sizable jump in our small and mid-cap exposure to reposition clients, because small caps became very attractive relative to large caps. So we wanted to position ourselves for the future. This helped us significantly as small caps has recovered the sharpest coming out of March and in through May. We talked about predictability and how, although every time might feel like it's different, asset class behavior tends to repeat itself. So historically, small caps do recover strongest out of market bottoms. They sell off the most, they recover the most. So making that shift helps give us a level of predictability, and just that, where might we want to be positioned on a forward-looking basis. Third, we rebalanced our client asset allocations back to target. So for example, if we had a client that was supposed to be 70% in stock and 30% in bond, after the 30 or so percent market decline, they might now have been 65% stock and 35% in bonds. So the value of their stock investments went down, the value of their bond investments went up, because we're focusing on higher quality bonds. And this allowed us to sell bonds high and use the proceeds to buy stocks low. So we brought them back to that 70-30 target, but at much more favorable valuations. And we also tax loss harvested. And tax loss harvesting, I'll explain what it is, but it's a great way to help us take advantage of really bad markets and improve tax efficiency for the future. Tax loss harvesting, it involves selling certain investments in taxable accounts at a loss and using those losses to offset future capital gains. And given the large number of attractive opportunities at the end of March, we were able to sell certain things and replace them with new holdings, all while building up a bucket of losses to offset against future gains. This helps us really improve our after-tax returns of the portfolio for the future. Going back to our biases, one of our biggest biases being loss aversion. We hate to see losses. We had to really coach clients who did not want to sell certain positions at a loss and reinvest those proceeds right away, just because it's uncomfortable to sell something if it hasn't recovered in its value. So that's part of our job and our coaching process, is saying, hey, the market's done what it's done. Let's be forward looking. Let's use this opportunity to focus on tax efficiency. And people really appreciate that when things are able to recover. And last but not least, a great client advisor relationship is all about communication. None of our clients were in this alone. We got through it as a team, and we're going to continue to do that through future bear markets. We did this by holding several live webinars. We had a town hall. Our advisors were frequently touching base with clients to help them stick with their plan, because we know emotions were running high, especially compounded with the fact that everyone was home and there's health risks involved. So we wanted to be there for our clients. And this all focuses on what's been done this year, but the same principles apply in all markets. It's proactivity, controlling what we can control, and good communication. I'm going to leave you with this, especially with the sense of calm back in the markets. It's a perfect time to ask yourself the following questions. Number one, how am I positioned going forward? Whether it's asset allocation, what's happening in your stock and bond portfolio, make sure you're at the right place at the right time and not putting yourself in a vulnerable spot in the event that towards the back half of the year into next year, we see an uptick in volatility again. Number two, be very realistic about your feelings and your behavior during the recent sell-offs. Did things go according to plan? Did you or your advisor go off script and become reactive to what was happening? Number three, how often and when do you act on potential future opportunities? As I said, we look at size and style changes monthly. We review our asset allocation plans with clients quarterly. Do you have a discipline to monitor and act when necessary? Sometimes having this in writing, like we do, and sticking to it, it's going to remove some of the emotion from investing and keep us on track. I know we covered a ton of information, but this is going to wrap things up for today. I want to thank everyone for their time and attention. Again, please forward any questions you have to seminar@berniewealth.com. You're going to be hearing from a member of our team in the next couple of days, offering and see if you'd like us to run a complimentary portfolio analysis just like the one we looked at today. And again, thank you. I hope everyone and their families continue to enjoy their summer. And we all hope you stay safe and healthy. Enjoy the rest of your week.